welcome to the next edition of the Fire Up Startup Insight series. We talk to investors and entrepreneurs turned mentors and also industry leaders turned investors that all work with startups. We pick their brains and their wisdom to share some insights on very, very specific topics that help startups. So today we have with us Krishna. Krishna is the founder of JSS Services. They do many things, and Krishna is also an active investor with the SucSEED Angel Network and then a few other channels. And so both professionally, Krishna comes from a very strong finance background and also has worked a lot with startups. So that's a perfect mix for the topic today, which is about finance and compliance, the finance processes the startups need to be aware of. So Krishna, thank you so much for joining us. Welcome to the Fire Up Insight series. So just to get the ground, let's start with can you just cite any instance whether you are personally aware of or you heard of elsewhere where a startup was in serious trouble because their books were not in order when they were doing their fundraise?
Right. So, there are, we are in a way, we are a startup ourselves. As we started about 9 years back, and then we were negotiating various hurdles of startup world along with our clients who were, also a lot of startups that we worked with. When the due diligence comes, and until the due diligence comes, usually finance, accounts, and compliance. These are three areas that become support areas, and they are not as important. They also are on par with most of the other support areas. However, finance, accounts, and compliance becomes extremely important when a due diligence happens. And we had seen some situations where some very simply correctable or what we call curable defects that were found in due diligences also had led to failures of due diligences. In one of the cases that I was participating in, the investor did not like the fact that Provident Fund compliance was messy. So, over time, of course, even the due diligence process has matured a lot. Investors do understand that, especially during the first round, they understand that compliances can be a little weak. End of the day, the compliance environment out there, although to our eye, having worked for so long in this environment, we don't think it is as complex as it is made out to be. But investors do understand that entrepreneurs usually are technocrats or usually are technology people, and they're not finance people, and so there are certain misses. So these days, what we see the trend is that we are asked to, when we conduct a due diligence or when we support a client during a due diligence, we are asked to identify and check whether the intention of the promoters is actually to conduct a non-compliance or not. However, just to give you, since you asked certain examples, just to give you a few, one of the very key things that we find which is missing is the legal and the basic legal infrastructure. For example, you have some key vendors conducting technology services for you, but you don't have proper agreements with them, which will jeopardize potentially or act as a threat to your IP ownership. Sometimes the investors don't have agreements or the promoters don't have agreements amongst themselves. There needs to be a basic shareholder agreement, because of which at some point, if the promoters have certain differences of opinion, it becomes slightly difficult and shakes the ship. Similarly, from a Companies Act standpoint, we see a lot of a lot of basic registers not being in place, share certificates are not around, the memorandum and articles not having proper clauses in place, because of which, again, the entire business could face certain big risks. In the same manner, the IP is not protected properly. You see trademarks and copyrights and basic stuff missing, because of which you see a lot of very similar things happening all around in the market, and that could pose certain threats. So there are the bigger things, and then the second biggest set of things that I would say are the penalties. What also happens is, because of not knowing or not properly checking, there are certain disqualifications and penalties. We come across this instance very frequently. People set up a company and then they shut down that business and start up afresh. However, they don't shut down the company properly, because of which they don't do the compliances there, and their directorship gets disqualified, and they're not qualified anymore to act as directors. So there are key things like that we look at these days. However, what we always recommend is if you can go with 100% compliance mindset. There are a lot of obscure laws, there are a lot of laws that are unknown, but it's still not very difficult to navigate if you just know the direction. So if the entrepreneur, the promoter is of the view that he has to be 100% compliant, I think this is something that can be easily accomplished with some effort, of course, some time, of course, which seems unproductive to start with, but when the investors come around, definitely that is something that will save our skin. So yeah.
So when it comes to, I mean, everything you mentioned are very, very likely misses. I mean, a founder is more interested in just getting stuff done, build your product, get your first set of customers, get them to try it out, and that's that singular focus to build the product and get the markets. And in that process, everything else, partly because they're not aware and partly because their mind is not even on it. And but specifically when it comes to finances, which is a more recurring, I mean, like everything else is structural, probably with some penalties, you can still fix it. But specifically with respect to finances, what are the typical misses you see when they get to a due diligence stage?
Right. So, there are, I would put this across in three layers, Ramesh. The first and the most fundamental layer is the basic internal control infrastructure, or internal control framework, or call it basic procedures. Like, for example, typically when you go walk into a startup, a small set of team, beaming with energy, doing a lot of work on technology, there will be one guy looking after the entire accounting. He will handle the bank account. He will handle all the payments, everything, right? So this guy is loaded with administration, accounting, compliance, and whatnot. Now, obviously, that points to, on one hand, risk of compliance is there, non-compliance rather is there. But on the other hand, you also see a lot of basic controls missing. That is, the same guy getting the bill, same guy discharging the bill will mean that there is a certain level of fraud risk, etc. also. So that is the first layer, which I would like to call the SOPs and the basic control framework that must be there. We always say there has to be a three-way match for every transaction and things like that. Then at the second level, we see that the processes are at the process people framework, or in simpler language, the plan which is connected to processes, and then the kind of KPIs that are set. There is no clarity there. So what happens is, everybody knows what the end goal of the business is, but how exactly are they going to go there? There is no clarity even in the smaller team, except the promoter. The others have a little bit of lack of understanding. And then at the top level, we are talking about the policy and vision itself. It always helps to have clarity at that level, because startups experience a very fast growth surge, especially soon after the first round of funding happens. And during that growth surge, if you want to start doing all these things, or even if you engage a couple of professionals to do all these things, it becomes difficult. So these are all the foundation or building stones, or the foundation stones for the startup to build. So missing these things, coupled with missing all the legal stuff and the compliances risks that are triggered, usually turns off a due diligence and then takes things in the wrong direction. Also, what happens sometimes is, at the end of this whole effort, they end up signing an agreement which has a lot of indemnities and a lot of protection for the investors, and just too many miles, potential landmines will get landed right before, even before the business takes off. So it's important that these things are kept in mind right through. From a best practice standpoint, the global best practice standpoint, if I were to say, we did have a chance to work with a few American, European startups as well. What they usually do is they start off by laying out the vision, putting together a compliance handbook, putting together a bunch of manuals and records. Sometimes we used to feel that they're overdoing it at the beginning, but that effort is almost like a one-time investment into your at least 5-year journey or life cycle, and it really pays off a lot.
I think it's good to, I mean, like I said, like you also referred, it's very rarely that there's a very willful intent to be non-compliant, right? Most often they just didn't think about it, or they just didn't know about it, or both maybe. Now, it'd be nice to put together a basic checklist or a basic handbook that we can tell startup, look, you take these 25 documents you must have. And here are the templates, you just fill it up, and then the right people sign it, and then you have your kind of a basic thing in place. And there's a checklist also. Now, one of the things that helps, I mean, maybe we'll take your help and see if we can put some very basic set of templates together for startups. But often help is taken from CAs and CS, company secretaries for sure, some cases even corp lawyers, just to lay there, because that's the first place you go to. I mean, anybody, you probably are engaging a CA or a CS to register the company and then like maybe are in touch. Just if you can help quickly explain the difference between a CA, a CS, and a corporate lawyer, just so the startups understand what the difference is and when to engage who.
Sure, Ramesh. So, see, in the financial world, like you said, there are chartered accountants, and then there are cost accountants, and then there are company secretaries. Cost accountants are lesser known in the non-manufacturing sectors, but then and then there are the lawyers who handle the legal. Now, at a startup stage, frankly speaking, all these three classes of professionals are equally equipped to handle the requirements. At a startup stage, typically there are two layers of work that needs to be done. One is all the formative, where you set up the company and then set up the bank account, and then you have to take a series of registrations. We are looking at a minimum of 7 to 8 registrations. Sometimes, depending on and if the business is of a nature that requires more, you would be having about 5 to 10 more as well. It could actually go up to around 15. But the point is that is all the registration work and the setup work. The second layer is putting together all the registers and the templates and the drafts, so that on an ongoing basis things can be taken care of. Now, usually from a effort standpoint, I would say 70 to 80% of the effort for a startup, right up till it reaches probably the first stage, is 80% in the beginning and about 20% only on a cyclical basis. So in fact, honestly, in my opinion, a chartered accountant or a company secretary or a corp lawyer, these days everybody does similar work at the startup stage insofar as registrations and the framework is concerned. But if you have, I would recommend a combination of maybe a CA and a lawyer, or a CA and a CS, mainly because the legal framework, if you put together that legal framework also, that is, like I said, the agreement between the promoters, agreement with key vendors, ensuring that the basic legal documents are all aligned with each other. The objects of the company says something else and the agreement says something else. These kind of things must be taken care of. What are the rights of each promoters? If there is some good delineation done by a lawyer there, I think that will really help too. So my recommendation would be a CA plus a lawyer. But if you want to do the basic framework, any of these three professionals should be able to do well. Now, coming to the post first round, or let me say, probably the company moves from a real fresh startup stage to a slightly established startup stage. In that stage, on the other hand, a company secretary's compliance requirements, although they do not grow significantly, there are certain ongoing cyclical requirements that you may need a company secretary to do. Like, for example, if you're now moving to a bigger office and then there is a change of a registered address, there is a filing that needs to be done. Similarly, if you're looking at changing the composition of the shareholders, or the first round is going to happen, so you need to do certain certifications and so on. From that viewpoint, probably slightly later, you can also bring in the third professional. So that should kind of, did I answer your question, Ramesh?
The third meaning, that will be a company secretary. Assuming you had a lawyer, you get the company secretary also.
Yes, that's right.
Okay.
So all these three professionals have very key roles to play in the growth of a business. But then startups want to be frugal, and all of these three professional lines today in India have learned to help startups, handhold startups through the initial stages. So you may not need all three of them to start with, but then over a period of time you would need them. So just to also give a quick lay of the land, chartered accountants usually handle all finance and accounting and taxation requirements, whereas company secretaries handle the regulatory part, as we call it. The regulatory part entails the entire Companies Act, which is Companies Act or the LLP Act or the Partnership Act are the driving acts between driving regulations, the four walls within which a business entity, depending on what the entity is, should function. So from that viewpoint, company secretary is going to take care of those four walls. So those four walls, if you construct right in the beginning, you're good. You don't need on a recurring basis, at least until you grow to a stage where you'll have much more compliances coming in from the act. Companies Act has new innumerable number of compliances, but from a startup standpoint, there are only 3 or 4 that needs to be done. And it's more of an annual requirement. Now, from a cop lawyer standpoint, there are again a bunch of different laws which are other than the tax laws and Companies Act, like the labor laws, for example. You have the Shops and Establishment Act, or you have the Maternity Benefits Act. Prevention of Sexual Harassment Act is something that you need to take care of right from day one. So these are all. If you need guidance on those, also you would need a cop lawyer. But again, like I said in the beginning, all three of them usually would have similar knowledge. And I also believe that 10% to 20% should come from the entrepreneur promoter himself. He should do his own research, understand, go by the book, and then engage these professionals.
So, just drilling down a little bit more on CA itself. I mean, just the finance part. Like, what are the various elements of finance and accounting and the finance compliance that a startup needs to be aware of? Yeah. The elements, what are the various elements that come into play?
So the accounting itself is a record keeping exercise where you are, there are certain, there is a certain guideline. It's called the generally accepted accounting principles. These are the gaps. Each country has its own gap. India follows the Indian gap. And of course, there's a lot more that I can say about that. But
so accounting is one. So you need to engage somebody to keep track of your expenses. I mean, record it. And in the right way, as that is compliant.
In order to do that over time, over years, tools have simplified a lot. Now, if, for example, you look at the latest version of QuickBooks, for instance, there is a certain level of definition that is automatically given along when you buy a license. So it's not as much Latin as it was in the past.
So without even a professional accountant, a founder could manage and in the early stages.
Yeah, one way of looking at it is that, Ramesh, but the other way also is you don't want to spend promoter time, which is the most important.
Exactly. I was going to say that, yes.
So but then what I'm saying is in the past, probably you needed a full-time guy to take care of that. Now it is
now you don't.
more automated and it is more easier. So you can give that accountant a little more role on the compliance, which is the second piece. Compliance, like I said, we have the taxes, broadly income tax and GST, and there are also other indirect taxes like the customs duty, etc.
And these all monthly filings.
Income tax is quarterly for a startup. GST is also quarterly. Annual return filing is a must in income tax, and GST.
So there's the GST filing. There is the income tax filing, which is the TDS.
No.
And there's TDS filing separately.
Within income tax, you have TDS, which is withholding tax, and TDS filings, and then you have income tax filing itself. So each month you have to pay the TDS that you make from the payments you make to various parties, and then pay it to the department. And on a quarterly basis, you have to file a TDS return. And on a quarterly basis, you should also pay advance tax on your profits. And at the end of the year, you file the income tax return. So this is the whole income tax part. Right. Now, there are certain specialized requirements depending on businesses, but I'm just talking about a basic startup. Now, when we look at GST, beyond a particular revenue, now it is 40 lakhs, I believe. Beyond that amount, you have to take a registration and you have to file GST returns again on a quarterly basis. And then after that, on an annual basis, there is an optional filing that you can do. Now, beyond a particular turnover, of course, you have to do monthly GST filings as well. However, for startups, this is a relief that is given by the Indian government. So this is GST. Now, if you're having certain imports, etc., then you also have to pay customs duties, and then there are interlinkages between customs duty and GST, etc. So let me not go into that. That is a little detailed, but you have to keep in mind that there is a certain thing called customs duty if you have foreign exchange transactions.
Krishna, can I ask a question in between, or should I hold it to the end?
Yeah, please hold it. You just put it on the chat window.
Okay, fine.
And then we have the, from a compliance standpoint, landscape standpoint, you have, these are the taxes. Then you have the Companies Act and certain regulations like FEMA and RBI in case, again, you have foreign exchange involved. Then you have the third part, which is the labor laws and other legal compliances. Now, of these, usually today when I see, we work with a bunch of accountants. Today, when I see accountants, usually they are well aware of accounting. Then they are fairly good with income tax, but parts of GST are gray area for them, and we see labor regulations and other regulations are a big gray area. So what I suggest is you bring in an accountant and then give him accounting work and a part of compliance that he's comfortable with, and the rest of the compliances you can always engage a consultant for the same. This is one part. Then there is a third part from a startup standpoint, which is reporting, which is something that I'd always suggest. You have a plan when you start off from an account standpoint, because finance is one thing which is an independent function in any organization. You go to the sales guy, he would like to say his sales performance is very good. If you go to the production guy, he'll say something else. But an finance guy is actually looking at it right from the top in an independent fashion. So if you can take a report from the finance person and then see whether you are going as per plan or not, that will be very good. So laying out a quick reporting schedule, maybe a monthly or a quarterly, and then ensuring that the accounts are closed at least once a month. These are two things that are missing in the startup world today, as I see it. This is something that is very, it's very much recommended, not only from a potential investment standpoint, but also from the entrepreneur governance and hygiene standpoint as well. So if you can bring in that reporting also, I think these three things, if you run well, Ramesh, I think startups would be fairly healthy.
So now, what's the time? I mean, you referred to an accounts person. Now, initially, it's going to be just a minimal, somebody coming in for maybe 1 or 2 hours a week, or maybe even a few hours a month to take care of it, right? I mean, they don't need until they are of a reasonable size. Like if they have a team of like 5 to 10 people and very few bills to pay other than payroll. So they can engage somebody who just spends a few hours a month and takes care of things, right? They don't need to hire somebody yet.
Yes, if you can, absolutely, Ramesh, there is no need to hire a full-time person at that stage. But only thing is, there are certain, at least from an administrative standpoint, if you have one guy who is taking care of, like, for instance, daily bill keeping, bill recording, just keep a small register in which you're, or maintain it automatically, and ensure that all the bills are properly saved. Because one of the things that happens is month-end accounting, when somebody is doing for the entire month, there may be certain missouts, and that ultimately leads to tax being higher, ultimately leads to, sometimes we see promoters are using their own credit cards to pay. One instance we had seen that the domain, investor took was taken aback when he knew that the domain, which is the most important part, is actually owned by the promoter. So it had to be transferred, and by the time they were transferring, the value of the domain is quite high. So would it attract some sort of taxation again? These are kind of things that come up. So, we have to ensure. And the other thing also, the most important thing is when IP is developed, when intangible assets are developed, people are not capturing them in their balance sheet. So when you look at a product company's balance sheet and a services company's balance sheet, they look alike. These are things that people falter when they do everything in the 2 days or 3 days a month. So what I suggest is, at least what we have been doing for clients that we advise, and what we always recommend to our companies also is, see if you can do at least a weekly accounting. And then on a monthly basis, the number of days that is required is the same. You're paying only for that 4 or 5 days, except you split these 4 or 5 days as 1 day each week and 2 days in the last week, and that will do the trick.
So weekly accounting and monthly statements are good practice.
Yes, they are very good.
So generate the monthly statements. In essence, close your books and you just reconcile what need to be reconciled. So weekly accounting and monthly closing of books and monthly statements is a good practice.
Yes.
Okay. So that's that. I think that's a good advice. Now, are there? I mean, like you did touch upon what kind of professionals they can hire. You can get a CA or a firm to spend those few hours a week and maybe a day a month at the end of the month. Are there other kind of service providers available that they can take that is in a SaaS model? There's a service that they could use, startups could use?
Ramesh, some of us are attempting on that. If we can get to a point where, like, for example, in the US, there is one service called bill.com. What they do is, when you upload a bill, it automatically gets accounted and all of that. But one of the key issues with doing that is in India, the compliance landscape is very closely linked with transactions. So there are certain transactions, for instance, on which GST credit is given to you. On certain transactions, it's not given to you. On certain transactions, you can take refund. So at least, even if we were to look at something like that, any accountant should be able to do that. In case there are certain tools that are really able to successfully navigate this, that can happen. but still you would need a professional who understands this whole landscape to take a look at it at least once a month so that you don't accumulate issues. Like for instance, one thing, ever since tax notices, especially on TDS, started being sent online, we observe that many businesses are not logging in and checking whether they have any notices. And we had found at least 10 to 12 instances where, as part of due diligence or reviews, they had identified suddenly that there was a notice that was there pending for a year or two, and then they had to pay that, and then they
penalties and
right.
Yeah. So the basic finance and compliance hygiene would happen if you engage somebody on a regular basis, a person.
Yes. Anyone, it can be anyone, or if you can also ensure there is a good checklist made for yourself. These are all, many of these are now online. GST is completely online, income tax totally online. There can also be a DIY checklist. Only thing is that, of course, requires certain amount of time and effort from the promoter then. But if you can get some professional to take a look at it, might work out cheaper for the.
Like you rightly said, promoter's time is much more valuable and should be spent doing the more relevant things. And this should be offloaded to somebody else. And in that process, you get professional help, and also you preserve the promoter's, founder's time. Right. Now, just while still on the topic of who will do it, what is the right time to hire a person? A full-time account. I mean, I know initially when you hire the person, maybe accounts come, admin come, few other things, but with an accounts as a trigger, what is the right stage of the startup in terms of size or transactions that make sense to hire a person?
See, the moment you have business flowing, when I say business, apart from the promoters, if you have 1 or 2 employees joining, or if you have a couple of vendors coming on board, or if you have a couple of
revenues
coming on board, any of these meters start moving, then you should bring on board an accountant, either full-time or part-time.
What could be the number of transactions per week, roughly? If you say like each is a transaction, every payment made or every income, check received. What's a good number to say, like as a yardstick? When it touches that number a week or a month, it's good to get a person.
See, Ramesh, rather than answer from experience, I would say we can take regulations itself as a guidance, right? Today, regulations are talking about 20 lakhs or 40 lakhs. 20 people, 10 people is probably the lowest number of people that a regulation talks about when they talk about applicability.
PFN, yes.
Yes, right. So 10, when you're looking at about 8 to 10 people, or when you're looking at a value of around 20 lakhs happening in business, then I think that is a
20 lakhs per month or per quarter?
So 20 lakhs, when I say probably a quarterly number is what I'm saying. So most of the
quarterly 20 lakhs per quarter. Okay, there's a 2 trigger points. When you have at least, when a team of 10 or 20 lakhs per quarter revenue, is a good time to start looking at somebody as a full-time person.
But either way, you still are bringing on board an auditor or a.
Those would anyway be there. The consultant continue, because the accountant may be just a BCom, somebody familiar with tools. You still need a CA to be anyway, at least for the monthly statements and the debut. So that's a good point. Even if you hire a person, you still need to have your CA with you, who's going to give the broader advice.
Yes.
So
just for the benefit of everyone, again, this is one thing that we normally see in our experience, that you have the same guy doing accounting and audit, and that is again something that investors don't like to see. It's always recommended that you have an independent auditor looking at things, whether you and not the same person reviewing all your bank statements, making your accounts, and then filing your taxes and then signing your audit report. That is not a very good practice.
So better to have somebody do the account, somebody else do the financial statements. That is a check and balance happening.
Yes. Audit alone should be done by someone independent, so that he is able to get an independent view and then give the right kind of guidance.
So now we talk about 3 people just for finance. There's an operational accountant, there's a CA who is your advisor doing the monthly statements, and somebody else who's doing the annual audit.
Yes, or you can combine 1 and 2.
At least 2. So at least 2 should be there.
Combine 1 and 2 and have 3 as a separate person. Yes. So which is why, there are several agencies now, including we have an agency. What we are trying to do is we're trying to help startups in handling everything under one roof. Because yes, you do have to manage 5 to 10 registrations, handle about 5 to 6 different kinds of compliances as a minimum. So yes, that is something that probably 2 agencies is something that you can't do away without.
So we've hit the time limit. It's half hour. There's one question that's come up. He said he got the registration before the 40 lakhs turnover. Does he still need to do the compliance and filings?
Right. So see, once you have a registration, you have to comply. So it
You
is
have to file. Even if you don't have much to report, you still have to file.
a nil return. That's all. So one way of looking at it is just file nil returns if you think you are going to hit the turnover soon enough. If you think the turnover is far away enough, then you probably could just surrender your registration. Right? There is a process for surrendering the registration. You can just surrender it and then take it again whenever you
when the revenue kicks in. Sounds good. So Krishna, you did refer to some of the services that you're trying to package for the startups. Whenever you have it done, please do let us know. We'll spread the word around the startups in our network.
We do have a startup package already in place. I'll share the details.
Please do. We'll send it across to the startups. And I'm sure, see, many of them, we do this at least once a year just to kind of reiterate again to the startups that such a thing is something you normally don't think of, you need to be thinking of. Right. So we'll send that as a reminder to all again.
Yeah. So what we had done, just to, I'll just close with that, is what we had done is we said that we should elevate it slightly and then provide these companies with also some amount of CFO perspective in terms of somebody who can do a business plan and then provide certain valuations, set up a target valuation and say that, okay, 3 years down the line, if you do achieve this plan, then this is what your valuation will be. And then, a little more method to that madness while handling the operational and tactical aspects. So that's what we had tried to do in our own way for the startup world. So I'll just share that, and then yes, you can share it around. We do have a couple of publications also, Ramesh. I'd be happy to share with you.
Please do. We'll forward to our startups. So Krishna, thank you so much for taking the time and joining us. This is quite helpful. This gets recorded, and then we keep sharing it with the network. We package some of these topics together and then share it as one set of related topics. We do that every so often. And this anyways on our YouTube channel, both on the IIIT CIE channel as well as the SucSEED Indovation Fund channel. So thank you so much. I mean, this will help startups even going for not just those that were listening today, but even other startups. So thanks so much for taking the time.
Thanks a lot, Ramesh. It's been my pleasure.
Thank you. Thank you so much. Thanks, Krishna. Bye.